Hey everybody, this is Danelle. Today we're going to talk about dollar cost averaging. Because there's so much fear, uncertainty, and doubt, and please feel free to refer to our last video regarding FUD and understanding what blue chip stocks are. Today we're going to talk about dollar cost averaging. It's a great investment strategy if you're interested in investing long term. It's a way that you can get into a particular asset over time without trying to figure out how to time the market. It's very difficult to know when the bottom hits for a particular asset, and it's also very difficult to know when we reach the very top. So, dollar cost averaging, especially for long term investors, is a great investment strategy. As you can see here, the market in general has been down, particularly as of today. You see a lot of red, you see some maroon. That just goes to show that the market is still down from what it has been over the past 4 to 5 months. It's May of 2022 currently as we record. As you can see, the market is usually separated by sectors. You have the technology sector, you have the communication services sector, healthcare, financial, etc. So this is what they call a heat map, excuse me. So this is what they call a heat map, and it just gives you a general visual of what the market is doing on a particular day. If you look at the S&P 500, which is a benchmark index that includes 500 of the top companies, it's been down year to date 18.68%, which means it's near bear market territory. Bear market territory is when a stock is down 20% or more from its recent high. So as you can see, in the past 5 months, the S&P 500 is nearing bear market territory. Same thing with the NASDAQ. The NASDAQ is a tech-heavy index. As you can see, it is down 29%. It is already in the bear market. And here's a look at the Dow Jones Industrial Average. It's a smaller indices of approximately 30 stocks, ranging in other areas from financial to oil and gas, a little bit of tech, and those different industries are sprinkled into this particular index. A lot of people look at the Dow Jones, and that is down at 14.57% year to date. So, dollar cost averaging is a great strategy because we don't know what the future holds. We don't know when the bear market is coming. We don't know when the bull market is coming. There's various indicators and people who have been doing this for a very long time and have an understanding of what could be possible, but it's very difficult to time the market. So, dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility. Volatility meaning the fluctuations, the up and down of a particular asset. In effect, this strategy removes much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. Dollar cost averaging is also known as the constant dollar plan. The goal of dollar cost averaging is to reduce the overall impact of volatility on the price of a target asset, as the price will likely vary each time one of the periodic investments is made. The investment is not as highly subject to volatility through dollar cost averaging. You avoid the mistake of making one lump sum that is poorly timed with regard to asset pricing. So when we look at Bitcoin, this is another great asset to dollar cost average into, particularly because the fluctuations are extremely stark and vast. So it's very difficult to time the market when it comes to Bitcoin. If you look at it year to date, it's down a lot. If you look at the past year, it's down a lot. It's a bear market. Go back to year to date, 36.88%. The previous high was around $68,000, so it's actually down more than 50%. So it's definitely in bear market territory and has been for several months leading back from last fall, winter time. So same thing with Ethereum. $2,000 currently. Year to date, it's down 46%. So it's down even more than Bitcoin over the past 5 months. So this will be another asset that could be a great candidate for dollar cost averaging. And just a quick look at the NFT space, we see volume has consistently veered downwards. over the last several days, looking at the daily volume. This wicked candle here and here had to do with the other side deed land. We also did a video on the other side NFT drop. And if you look at the monthly volume, you see January was a spectacular month for NFTs, and we've begun to dip down going into May. So now we're going to go to an investment return calculator. We like NerdWallet's calculator. It's very simple. There's a lot of other calculators out there that you can use with different variations, but we're just going to keep it simple for today. We're going to start off with an initial investment. You're going to put in your regular contributions using a strategy known as dollar cost averaging. You can put in monthly or annually. Then you're also going to choose the term in terms of how long you expect your investment to grow. And then we're going to also put in the expected rate of return. We look at the S&P 500 as a benchmark. On average, it's about 10% per year historically is the return. Of course, it's not 10% every year. For example, last year was a phenomenal return of over 20%, but this year could be in the negative. There's been years where it has been in the negative. So just averaging out, you're going to get about 10% per year, meaning that if you keep your money in the S&P 500, about every 10 years, your money should double, giving you a 100% return on your investment. We're going to go here to the top. We're going to start off with a zero initial investment. Make a monthly contribution. We'll do $100. We're going to do 10 years for it to grow. So putting in $100 for the next 10 years every month. And we're going to go even lower than the S&P 500 expected rate of return. We're going to go 8%. So $100 every month for 10 years. Let's see what our investment will be worth after 10 years. It'll be worth over $18,000. Just by putting in $100 into an asset that returns 8% per year with compound interest, meaning the interest continues to accrue per year. You add on top of that per year, the return becomes more and more every year as it grows. Let's put in 20 years and calculate. Once again, starting off with a zero initial investment, $100 per month for 20 years, 8% expected rate of return. Let's calculate. $59,000 if you do this for 20 years. So you can play around with this, but it's very interesting to see what can happen if you just periodically put money into an investment. Let's just do one other variation here. Let's do the 10% expected rate of return over 20 years. Let's calculate. $76,000. Let's do one more quick dollar cost averaging calculation using Bitcoin. This is dcabtc.com. We're going to do $100. Let's do it, we'll do it monthly over 3 years. And this is calculating what your portfolio would have been over the last 3 years. So starting 3 years ago, you've put in $100 monthly for 3 years. If you did that 3 years ago with Bitcoin, your value is now $10,000. Your initial investment of $3,600, $100 per month for 3 years, more than 3x, or nearly 3x, I should say, because it's 184% change up to $10,000. So this is the power of dollar cost averaging. Please let us know if there's anything else that you would like us to cover in the world of investing. We're going to continue to give you more information regarding the crypto market, the NFT market, and investing in general. We're all here to learn together. We're not financial advisors. Please make sure to do your own research. It all depends on your individual circumstance and what you're willing to invest. If you need help, feel free to go find a financial advisor who can help you with making your investment decisions. In the meantime, we look forward to connecting with you. Take care. Bye bye.